Welcome back to Talk Tickers. This is the deep dive for the experienced investor, where we strip away the fluff, ignore the PR spin, and get straight to the P&L.
It is good to be back, and today we have a really fascinating case study on our hands.
We really do. We're dissecting the Q4 2025 print from Camden National Corporation, ticker symbol CAC.
And it's a classic regional bank sort of execution quarter that the market seemed to love for about 5 minutes and then immediately decided to punish.
It was a real roller coaster. The print dropped yesterday. We saw the stock pop, almost a full percent?
Yeah, plus 0.78% initially. Looked fine.
And then today, it just puked. Down almost 3.5% to settle around 45.73. So our mission today is to figure out why. Why did the market sell the news on what, at least on paper, looked like a record-breaking quarter?
Right. And record-breaking isn't our word. That's management's specific phrasing. But you can see why they used it. GAAP EPS came in at $1.33, beating by a penny.
And revenue, that's net of interest expense, hit $68 million, beating by about $1.7 million.
On top of a record net income of $22.6 million. So, you're checking all the boxes.
Top line beat, bottom line beat, record income. That should be a recipe for a green candle on the chart. But clearly, something in the plumbing here spooked the street.
Well, that's exactly why we do this. In banking, the headline is almost never the whole story. You have to look at the quality of those earnings.
Right. Is it sustainable?
Exactly. Is it coming from the core business or from one-time tricks? And more importantly, what is the forward guidance telling us about the next 6 months?
Let's start with the profitability snapshot. The metrics looked pretty robust to me.
They were very strong, especially relative to peers. Your return on average assets, ROAA, was 1.28%. Return on equity was around 13%.
Okay.
But the number that really jumps out, and this is the one sophisticated investors focus on, is the return on tangible equity, or ROTE. That came in at an impressive 19.06%.
Okay, so for the listener, just explain that tangible distinction. Why does that matter so much?
Yeah, great question. It basically strips out all the fluff on the balance sheet. Goodwill, intangible assets, stuff you can't sell if things go south. It gives you a much cleaner view of how hard the actual cash capital is working.
Got it.
And for a regional bank to be hitting almost a 20% return on tangible equity right now, that is top-tier performance. It means the engine is running very, very hot.
And the fuel for that engine seems to be the margin story. We always talk about NIM, net interest margin. It feels like for the last 2 years, every bank call has just been an apology for compressing margins. But Camden actually expanded.
They did, and significantly. This is really the headline metric that matters most. NIM expanded 13 basis points quarter over quarter to 3.29%.
Wow.
Even core NIM, if you strip out some of the noise, was up 10 BPs to 2.92%.
So what does that actually tell us about their business right now?
It means the spread game is working for them again. They're finally paying less for their money while still earning decent yields on their loans. The driver here was aggressive deposit cost management. Following the recent Fed rate cuts, they managed to drop their funding costs by 11 basis points down to 1.79%.
1.79%. That seems incredibly low. How are they pulling that off?
It's what we call catching the falling knife, but in a good way. As soon as the Fed cut, Camden aggressively lowered the interest they pay out on savings accounts. They just moved faster than their loans repriced downward.
And that creates that temporary widening of the profit margin.
Right. It's a game of speed, and they absolutely won this quarter.
Okay, so high returns, expanding margins, and we have to mention the efficiency. The efficiency ratio came in at a very clean 51.69%.
Which is incredibly lean. To put that in perspective, most regional banks are fighting to get under 60, maybe 55%. Running at just over 50% means you're spending about 50 cents to make a dollar. It's a well-oiled machine.
Okay, hold on. Beat, margin expansion, high efficiency. If I just heard that, I'd be buying the stock. And yet it's down 3.5%. We need to unpack this. Let's get into the deep dive. Look at the plumbing and the potholes, because the market saw something it hated.
It certainly did. Let's dig in.
Topic 1, the deposit and margin trajectory. We just praised the margin expansion, but is the market worried this is as good as it gets? Is this a peak margin anxiety?
That is the multi-million-dollar question. The bull case, which management laid out very clearly, is that they've successfully managed their deposit betas downwards.
Deposit beta. Let's just quickly clarify that for everyone.
Sure, it's just a fancy way of measuring how much your deposit costs change when the Fed changes rates. Management is basically arguing they have a high downward beta. They can cut payouts to customers quickly without those customers leaving.
So they have pricing power. They don't have to bribe people to keep their money there.
Exactly. And they have this big repricing opportunity coming up, right? That should help the margin even more.
Right, I saw that. 40% of their CDs are repricing in the next 3 months.
Correct. And those CDs are currently on the books around 3.35%. If market rates stay where they are, they can roll those over at lower rates. They're even guiding for a couple of basis points of core margin expansion in Q1.
So the math says margins go up. So why the bearish reaction? Why sell?
It's the fear that the easy money has been made. I think investors look at that 13 basis point jump in Q4 and think, okay, that was a big pop from the first Fed cuts.
Well, it's a one-time thing.
It might be.
Well,
if the Fed pauses or if competition heats up again, that expansion could just vanish. Plus, and this is crucial, management guided for flat deposits in Q1.
oh, there it is, flat deposits.
Exactly. In banking, deposits are your raw material. If you aren't growing that pile of money, you have to squeeze harder to get profit out of the existing pile. And the market hates stagnation. It interprets flat deposits as we can't grow without paying up for it.
That makes a lot of sense. It's that classic price for perfection problem. Okay, let's talk about topic 2, which I think definitely contributed to the jitters, the one-off credit event.
Ah, yes. The $3 million charge-off, the elephant in the room.
So for the listener, they had a commercial office loan on their watch list for almost 2 years. In Q4, they finally just ripped the Band-Aid off, did a short sale, recovered 88% of the loan, and took a $3 million hit to clear it.
And CEO Simon Griffith framed this as prudent and proactive. Take the hit now, limit future exposure, move on. He pointed out that office CRE is only 3.7% of their total portfolio.
Which sounds reasonable, doesn't it? It's like cleaning out the garage. You find something nasty, you toss it, you move on. Why panic over 3.7%?
In isolation, it sounds fine. But here's why the market didn't like it. A $3 million hit in one quarter for a bank this size is a visible dent. And it raises the cockroach theory.
There's never just one cockroach.
Exactly. When you see one significant loss in the office portfolio, you immediately ask, is this the last one? Or is this the canary in the coal mine for the other 3.7% of the portfolio?
Right, because if you recover 88% on this one, that's great. But what if the next one is a 60% recovery?
Precisely. While 3.7% sounds small, banks are highly leveraged. If you have to take, say, 15 or 20% losses on that entire bucket, that wipes out quarters of earnings. It just signals that the distress in their office sector is real enough to force a realized loss.
So even though they cleared it, the fact that they had to clear it creates anxiety. It changes the narrative from pristine credit to managing problems.
Correct. It's a blemish on an otherwise very clean sheet.
Okay, let's move to topic 3, loan growth. Or I guess I should say the lack of it.
Yeah.
Total loans are actually down 1% in Q4.
Yeah.
For a bank, shrinking the loan book is usually a massive red flag.
It is, but there's some nuance here. Management claims this wasn't a lack of production. They said the amount of new loans they wrote was actually comparable to Q3. The issue was high prepayments and payoffs.
So people were paying off loans faster than they could write new ones.
Exactly. Borrowers were paying back loans faster than Camden could put new ones on the books. This can happen when rates drop slightly, people refinance, or when businesses have excess cash and decide to delever.
Is that a good problem or a bad problem to have?
It's a mixed bag. I mean, it's good for credit safety. It shows your borrowers are healthy, but it creates a huge revenue headwind. You're losing that interest income from a shrinking asset base.
And the outlook. Are they going to keep shrinking?
The pipelines look pretty solid. They cited $83 million in residential and $77 million in commercial. Management is guiding for mid-single-digit loan growth in 2026, but accelerating specifically in April and May.
Growth later is always a tough sell on Wall Street.
Always. Especially when you combine it with the flat deposit guidance for Q1. It just paints a picture of a stagnant balance sheet for the next 3 months. Investors are looking at Q1 and thinking, okay, so this is dead money for another 90 days.
Right. Okay, let's pivot to something I actually found fascinating. Topic 4, the bots. We mentioned that 51% efficiency ratio. How are they doing it?
They are automating the back office more aggressively than almost any regional bank I've seen. Management explicitly cited using 143 automation bots processing 5 million tasks.
143 bots doing 5 million tasks. That is wild. Are we talking like physical robots roaming the halls in Maine?
No, sadly not. These are software bots, RPA, robotic process automation. They take over all the repetitive, soul-crushing tasks, data entry, verifying things, moving files around.
And that explains the expense control.
It explains why their non-interest expense is so well controlled. They aren't hiring an army of people to process data. They have software doing it 24/7. This is the whole operating leverage story. If they can get that loan growth back, the revenue drops straight to the bottom line.
It's scalable. They also mentioned the digital engagement side. They launched a family wallet and saw a 19% increase in digital engagement for customers under 45.
And that's crucial for the long term. If you want lower deposit betas, you need sticky primary banking relationships. You need to be the app they check every day. They're self-funding this tech growth by automating the manual stuff. It's a really smart strategy.
Okay, so we have the mechanics down. Let's zoom out to the investor context. What's this mean for the person holding the stock?
Well, first, capital allocation. They authorized a new buyback program for 850,000 shares. That's roughly 5% of the company.
It's a decent chunk, puts a floor under the stock price, theoretically.
Theoretically. But let's look at their M&A strategy, because this was interesting. CEO Griffith was very specific. They're opportunistic, but picky. They like contiguous markets, northern New England, New Hampshire.
And he explicitly said where they don't want to go. This caught my ear.
Yes. Boston. He said looking at Boston is stretching the envelope, and it's too different a risk profile for them.
That is a very telling comment. Usually a regional bank is dying to get into a big city for growth. Camden is saying no thanks. Why?
It just aligns with their conservative credit culture. Boston commercial real estate is hurting right now. Vacancy rates are high. By staying away, they avoid that volatility, but they also limit their total addressable market. It's a trade-off. Safety versus scale.
It sounds like they're very comfortable knowing who they are.
Which is a huge virtue in banking.
Let's bring it back to the price action. Down 3.5% today. The one-year total return is just under 5%.
Which is lagging. The KRE, the regional bank ETF, is up about 10%. The S&P 500 is up 15%. So Camden is a significant underperformer trying to play catch-up.
And today's drop certainly didn't help.
No. The market is trading on forward spread economics. Investors looked at this call and said, great Q4, but you're telling me deposits are flat, loans shrank, and you just took a loss on an office building. I don't care about your record income. I care about your growth rate next quarter. And that's why it sold off.
Tough love. They want the what have you done for me lately and the what will you do for me tomorrow story. And flat is not a great story.
Exactly. Even if flat is prudent, flat does not get you a higher multiple.
Okay, we've broken it down. Now it's time for the segment everyone waits for.
Oh boy. Here we go.
It is time for This is Not Financial Advice.
The big disclaimer time. We are not financial advisors. We're our two voices on a podcast. Do your own due diligence. Please do not trade based on what we say. We are just brainstorming here.
Exactly. But if I were a hedge fund analyst pitching a trade based solely on this earnings call, here's what I'd pitch. I call it the bot versus Boston pairs trade.
I like the name. Break it down.
Okay, so the long side is Camden National. CAC. You are buying the bots. You're betting on that 51% efficiency ratio. You're betting that the geography Maine, New Hampshire is insulated from the worst of the Metro Center real estate problems. You're buying the thesis that the $3 million charge-off was discipline, not desperation, and that their 88% recovery rate proved they know how to manage troubled loans better than their peers.
So you are basically going long competence and efficiency.
Exactly. Long northern efficiency. Now the short. Who are we getting against?
I'm assuming this has something to do with that Boston comment.
The short is a basket of Boston-centric commercial lenders, the banks that are heavily exposed to downtown Boston office space.
Because Camden's CEO explicitly told us Boston is soft.
He basically gave you the alpha. He's saying, we aren't going there because the risk is too high. So you short the banks that are there.
That is actually plausible.
Right. The catalyst is that as 2026 progresses, the bots keep Camden's expenses flat. Meanwhile, the Boston banks start taking much heavier charge-offs on office CRE because they can't recover 88%. Maybe they only get 60%. You capture the spread between northern efficiency and city center distress.
It's aggressive. It assumes that Camden's lack of growth is better than Boston's bad growth, but it's a coherent thesis. You're using Camden's conservative guidance as a weapon against their competitors.
Exactly. Long the woods, short the city.
Just remember, if the Boston economy roars back or if Camden's loan book shrinks another 2%, that trade blows up in your face.
And that's why it's not financial advice.
Indeed. It is a high-conviction geographic play.
All right, let's wrap this up. Recap for the listener on the go. What are the key takeaways?
Camden National Q4 2025. 1. Strong headline numbers, EPS beat, revenue beat, and incredible efficiency at 51%, driven by automation. 2. Net interest margin expanded significantly to 3.29%.
3. The market hates the loan shrinkage and got spooked by that $3 million office loan charge-off. The stock dropped 3.5% on the news.
It's just a battle between backward-looking records and forward-looking anxiety. Management says growth returns in Q2. The market is saying, show me first.
Final thought for the listener.
My final thought is this. Look at that efficiency ratio again, 51%. In a world where revenue growth is hard to come by, the banks that can control costs are the ones that survive. The question isn't whether they will survive, it's whether they can thrive enough to get that stock price moving again.
And is that 3.5% drop a buying opportunity, or is it a warning sign that the easy money in regional banking is just gone?
Yeah.
That's for you to decide.
Indeed.
Thanks for listening to Talk Tickers. Don't forget to check the show notes for all the numbers. We'll see you on the next print.